If someone told you that a handful of ETFs could pay you every single month enough to cover your rent, your bills, even your salary, you probably think it's too good to be true. But what if it isn't? What if there really are funds that generate steady monthly cash flow without needing you to pick stocks, time markets, or spend your life chasing the next big thing? Because today, we're diving deep into the world of income ETFs, the kind that pay real consistent money while you sleep. And yes, some investors out there are earning more from these 7 ETFs than they ever did from their 9-to-5 jobs. It all starts with a mindset shift. Traditional investing teaches you to think in terms of net worth, build a big portfolio, and one day, maybe decades from now, sell small pieces of it to live on. But that strategy depends on market timing, emotion, and luck. The income investing approach flips that idea completely. Instead of selling shares, you live off the cash flow, dividends, distributions, and option premiums that arrive every single month. Your portfolio becomes a paycheck machine. The first ETF that made this concept mainstream is JEPI, the JP Morgan Equity Premium Income ETF. JEPI is a beast. It holds a diversified basket of U.S. blue chip stocks, mainly S&P 500 names, and then sells covered calls on them to generate income. The result? A monthly yield that hovers around 8% to 10% paid out like clockwork. That means if you had a $100,000 investment, you could expect about $700 to $900 every month in distributions. It's not hype, it's math. And because JEPI focuses on high-quality companies and actively manages its call options, the risk-adjusted performance has been surprisingly strong even during volatile years like 2022. Right next to it is GPQ, JEPI's tech-focused cousin. This ETF targets the NASDAQ 100 instead of the S&P 500, using the same covered call strategy but with more exposure to big tech. Apple, Microsoft, Amazon, and Nvidia. That means higher growth potential, but also a bit more volatility. The yield, around 10% to 11%. Many investors combine JEPI and JEPIQ for balanced exposure. JEPI provides stability, while JEPQ brings in the tech income punch. Together, they create one of the most efficient monthly income engines on the market. But let's say you want even higher yield and the kind that really replaces a paycheck. That's where QYLD, RYLD, and XYLD come in, the Global X Yield Trio. These ETFs are the purest form of covered call income plays, each targeting a different index. QYLD covers the NASDAQ 100, RYLD covers the Russell 2000, small caps, and XYLD covers the S&P 500. The yields can range from 11% to 13%, sometimes even more depending on market conditions. The trade-off? Limited upside growth because covered calls cap your capital appreciation. But for investors focused on steady income, not speculation, these ETFs can feel like owning a self-funding paycheck. For example, if you invested $300,000 spread evenly across JEPI, GPQ, and QYLD, you could expect roughly $2,500 to $3,000 in monthly income right now. That's before any dividend reinvestment or compounding. For many people, that's more than their rent or even a part-time salary. Now let's talk about 2 lesser-known but powerful additions to the income mix: SCHD and DVY. These aren't covered call funds, they're dividend growth ETFs, which means they focus on owning companies that consistently pay and increase their dividends year after year. SCHD, for instance, tracks the Dow Jones U.S. Dividend 100 Index, names like PepsiCo, Verizon, Texas Instruments, and Home Depot. It yields around 3.5%, but its growth in dividends is the real secret. Over the past decade, SCHD has increased its distribution almost every single year. It's the ETF that quietly gets better with age. DVY, or the iShares Select Dividend ETF, is another cornerstone. It focuses on U.S. companies with a long history of paying stable dividends, mostly in utilities, energy, and industrial sectors. The yield is roughly 3.7%, but like SCHD, it offers consistent tax-efficient income, perfect for those who want reliability without the complexity of covered call strategies. And finally, there's HDV, the iShares Core High Dividend ETF. Think of it as a dividend-paying fortress, packed with blue-chip names like ExxonMobil, Johnson & Johnson, and Coca-Cola. It's built to survive bear markets, recessions, and everything in between. Yields hover around 4%, and the price stability gives investors peace of mind. Now, if you add all 7, JEPI, JEPQ, QYLD, RYLD, XYLD, SCHD, and HDV, you can build a portfolio that delivers consistent income across all market environments. The covered call ETFs provide high yield and monthly cash flow, while the dividend growth ETFs give you long-term stability and rising payouts. It's a beautiful balance of offense and defense, monthly income now and growth later. Let's break down what kind of capital you'd need to actually replace your income. Say your goal is $4,000 a month, and that's $48,000 per year. Using an average yield of 8%, you'd need a portfolio of around $600,000. If your target is $3,000 a month, that's about $450,000. It sounds big, but here's the reality. If you invest $2,000 a month at an 8% total return, you could reach $450,000 in just about 12 years. That's within reach for many people. Even better, if you start with $100,000 and invest $1,500 monthly, you could get there in 10 years. Add consistent reinvestment of dividends, and that timeline shortens even more. The key isn't perfection, it's persistence. Now, it's important to talk about risk, and because income doesn't come free. Covered call ETFs like QYLD and GEPQ are known for their high yields, but they sacrifice upside growth since selling call options caps your potential gains. That's fine for income-focused investors, but not ideal for those seeking explosive long-term compounding. The best solution is blending, using growth-oriented dividend ETFs like SCHD or HDV alongside the high-yield covered call funds to smooth volatility and maintain total return potential. Also, remember that covered call income is taxed differently. Most of it is treated as short-term capital gains, which can be taxed at higher rates than qualified dividends. That's why many investors prefer holding these ETFs in tax-advantaged accounts like IRAs or Roth IRAs. Dividend growth ETFs, on the other hand, are generally more tax efficient since their payouts often qualify for lower tax rates. Structuring where you hold each ETF can make a big difference over time. Let's walk through an example of a balanced, income-optimized portfolio targeting $3,000 per month. 25% JEPI for core stability and yield, 20% JEPQ for tech-driven income, 15% QYLD for extra monthly cash flow, 10% RYLD and 10% XYLD for diversification and global yield exposure, 10% SCHD for long-term dividend growth, 10% HDV for defensive stability. At roughly 8% blended yield, that mix would produce around $2,900 to $3,100 per month on a $450,000 portfolio. The beauty? You'd receive those distributions monthly, meaning your portfolio becomes a replacement paycheck, not a savings account you have to deplete. But here's the big secret. You don't need to hit the goal all at once. Even partial income changes your life. Imagine covering just your groceries or your rent through dividends. Suddenly, your job stress feels lighter. You gain breathing room, and that's the start of real freedom. Over time, you can reinvest any surplus income until your distributions match or exceed your expenses. It's a self-reinforcing loop. Income generates more shares, which generate more income, until the snowball becomes unstoppable. This is what wealthy investors understand instinctively. It's not about getting rich quick. It's about creating a system that pays you forever. The market may rise and fall, but the cash flow never stops. And once your investments cover your life expenses, everything else you earn becomes optional. Of course, diversification matters. You don't want your entire income relying on a single strategy. Covered calls work beautifully in sideways markets, but can lag in strong bull runs. Dividend growth ETFs, on the other hand, thrive during growth periods. Together, they smooth out the ride, allowing you to collect consistent income in any environment. Another key piece of this puzzle is mindset. Income investing is slow, steady, and sometimes boring, and that's exactly why it works. The goal isn't excitement, it's stability. The people who truly reach financial freedom are the ones who automate contributions, reinvest diligently, and let time do the compounding. And let's not overlook taxes, healthcare, and emergency planning, essential parts of living off dividends. Ideally, you'd want at least 6 months of expenses in cash, so you're never forced to sell during downturns. Health insurance and predictable budgeting become crucial when your primary income is investment-driven. But the flexibility you gain, being able to work because you want to, not because you have to, makes it all worth it. Now imagine what happens 5, 10, or 20 years from now. You've built a dividend machine that spins off cash flow every month. Your JEPI and JEPQ distributions arrive like clockwork. SCHD's dividends have doubled, and your portfolio is now worth more than when you started, even after years of withdrawals. That's the power of compounding income layered over growth. And the moment it clicks, when you realize your portfolio has officially replaced your job's paycheck, it feels surreal. You start to understand what financial freedom truly means. It's not just about quitting your job, it's about owning your time. Because every dollar of dividend income is a tiny piece of your life returned to you. It's one more hour you don't have to trade for a paycheck, one more day spent on your own terms. That's what these ETFs represent, not just investments, but freedom engines. And here's the truth. You don't have to be a financial genius to make this work. You don't need to outsmart Wall Street or predict the next crash. You just need consistency, discipline, and a belief in time-tested principles. Every month your ETFs are out there working for you, collecting dividends, selling calls, generating yield, all while you live your life. It's quiet, it's predictable, and it's powerful. So when people ask, can you really live off ETFs? The answer is yes. If you plan it, automate it, and stick to it, absolutely yes. The 7 ETFs, JEPI, JEPKI, QYLD, RYLD, XYLD, SCHD, and HDV, can become the financial backbone of your life. They can give you what most jobs never will, income that doesn't depend on your time. If you're 25, maybe you want total return and compounding. But if you're 45, building a second stream of monthly income, that trade-off is not just acceptable, it's brilliant. To see how it plays out over time, let's run a few numbers. Suppose you invest $100,000 into a basket split between JEPI, JEPQ, and QYLD, averaging a blended yield of about 10%. That's roughly $10,000 per year, or $833 per month before taxes. Now add consistent monthly investments, say $1,000 each month, with dividends reinvested and assuming an 8% total return, yield plus modest price growth, your portfolio could surpass $500,000 in about 13 years. At that point, if you decide to stop reinvesting and start drawing the income, that same 10% yield would throw off $50,000 a year, more than $4,000 per month. That's the power of steady contributions meeting compounding cash flow. Now imagine taking that same strategy but diversifying across risk profiles. JEPI and JEPIQ provide a balance between growth exposure and steady distributions. QYLD, which sells calls on the NASDAQ 100, is a heavier yield play. It can pay over 12%, though that's partly a return of premium. Some investors combine them in ratios like 40% JEPI, 30% JEPQ, 30% QYLD for a blend of consistency, yield, and tech exposure. Others prefer 50% JEPI for its defensive quality, then split the rest between RILD, covering the Russell 2000, and XYLD, covering the S&P 500. By mixing across indexes, you avoid being tied to the performance of just one sector. And while each fund's payout fluctuates, the overall income line stays surprisingly stable. Taxes, of course, are the silent factor many forget. Covered call ETFs often generate distributions that are a mix of qualified dividends, ordinary income, and return of capital. That means you might not pay a flat 15% rate as you would with traditional stock dividends. The best way to handle this? Hold them in tax-advantaged accounts whenever possible, like an IRA or Roth IRA. In a Roth, all those monthly payouts grow and distribute tax-free. If you're building toward financial independence, that difference can be massive, tens of thousands saved over decades. But even in a taxable account with smart planning and offsetting deductions, your effective tax rate on this income can be lower than most people assume. What's fascinating is how many ordinary people are using this approach, not to get rich quick, but to buy time. There's a quiet community online, teachers, engineers, retirees, even students, who track their monthly payouts like others track salaries. They post screenshots, $423 this month, $441 next month, $450 the month after. They're not millionaires, but they're slowly replacing hours worked with hours owned. Some even call it dividend time freedom. You might not quit your job tomorrow, but you could reduce your hours or choose work you actually enjoy because your bills are partly covered by a portfolio you built yourself. Now let's get practical. Suppose your goal is to replace $3,000 a month in take-home pay. At an average 9% yield, you'd need roughly $400,000 invested. That might sound intimidating, but break it down. Invest $2,000 per month, compound at 8% total return, and you'll reach that mark in about 11 to 12 years. If you can push $2,500 a month, it drops closer to 9 years. And if you're starting with a $50,000 base, even faster. The math isn't magic, it's just consistency. Every dollar reinvested buys you more future income. Every month you stay invested shortens the distance to freedom. And of course, diversification matters even among dividend ETFs. JEPI's portfolio leans heavily into large cap value names, Johnson & Johnson, Coca-Cola, ExxonMobil, PepsiCo, companies that pay and stay. JEPIQ adds tech exposure, Apple, Microsoft, Alphabet, but with the safety net of option premiums. Meanwhile, QYLD is more income aggressive, generating high yield by selling calls monthly, but at the expense of growth. The art is in balancing these pieces based on your tolerance for volatility and your need for cash flow. For many, a 40-30-30 split gives a nice equilibrium, steady dividends, modest growth, and limited drawdown risk. Let's take it one step further and talk about sustainability. What happens in a deep bear market? During 2020's pandemic crash, JEPI wasn't yet trading, but similar funds saw payouts dip slightly, yet far less than the collapse of stock prices. Why? Because the options premiums actually rise when volatility spikes. That means these funds can sometimes maintain or even boost income when markets tumble. Your portfolio might be down 10 to 15%, but your income remains largely intact. That's precisely the stability retirees crave, and why many now blend these ETFs with dividend aristocrat funds like VIG or SCHD for extra resilience. Now, risk isn't zero. Covered call strategies underperform in explosive bull runs. If markets rally 20% in a year, your upside may be limited to 8 to 10%. But that's not a bug, it's a feature. Because in most real-world years, markets aren't exploding, they're meandering. The steady drip of cash flow smooths out those unpredictable cycles. It's like choosing a reliable salary instead of an unpredictable commission check. You might not hit the jackpot, but you also won't face sleepless nights wondering if you can pay rent next month. For those serious about building income, tracking tools like Track Your Dividends or Portfolio Visualizer can show your expected monthly payout and simulate growth under different scenarios. Watch your income snowball grow each quarter. It's immensely motivating because you start to see the future, not in vague retirement years, but in tangible calendar-based paydays. You stop thinking in terms of net worth and start thinking in monthly income units. A $500,000 account paying 9% doesn't just represent $500,000, it represents $45,000 per year of working optional cash flow. Suddenly, money becomes less about accumulation and more about autonomy. Now let's zoom out. Why do these ETFs even exist? Because investors demanded an alternative to the growth at all costs culture of the last 2 decades. After multiple boom and bust cycles, people realized that realizing profits on paper doesn't pay the bills. Income does. Vanguard's Jack Bogle once said, "Don't look for the needle, buy the haystack." These ETFs take that principle and add a paycheck. Instead of selling shares to live, you live off what your shares generate. It's a subtle but profound psychological shift, from consumer of markets to owner of cash-flowing assets. Imagine waking up on the first of every month, checking your brokerage app and seeing dividends automatically deposited. No boss, no commute, no clients, just your portfolio doing its job. That's not fantasy, it's math multiplied by patience. Even starting late, at age 40 or 45, the runway is long enough. Time and reinvestment remain the twin engines of freedom. And there's a mental benefit too. When you're living off dividends, you stop reacting to daily market noise. A 2% market dip doesn't scare you if your monthly income is unchanged. You shift from price anxiety to income serenity. It's the difference between constantly checking Zillow for your home's value versus collecting steady rent from tenants. One is speculation, the other is ownership. Of course, the ultimate test is sustainability through real recessions. Historical backtests show that even during the 2008 financial crisis, similar income strategies recovered within a few years thanks to steady distributions. In contrast, purely growth-focused portfolios often required selling assets at a loss to generate cash flow. Here, patience literally pays. The investor who kept reinvesting dividends through downturns ended up far wealthier than the one who panicked and sold. For younger investors, combining monthly income ETFs with growth ETFs like VTI or SCHD creates a powerful dual engine, income plus appreciation. You can start small, maybe $500 in JEPI, $500 in VTI, and let it grow naturally. By the time you hit your 30s or 40s, that small position could be spitting out hundreds per month. The earlier you start, the less you need to contribute later. And if you want to go one step further into mastery, track your yield on cost. The effective yield based on your original investment. If you bought JEPI at $50 and it now pays $5 per year, that's a 10% yield on cost. But if years of reinvestment reduce your average cost basis to $40, that's actually a 12.5% yield on cost. It's not just the nominal yield that matters, but how efficiently your money is working for you over time. So maybe you start this month, one ETF, one step, one share at a time. You don't need to time the market, you just need to spend time in it. The math takes care of the rest. Reinvest, stay disciplined, and let the monthly deposits become your future salary. In a world obsessed with instant gratification, the patient investor who builds predictable income is the one who truly wins. And that's the beauty of it. These ETFs, JEPI, GPQ, QYLD, and their cousins aren't glamorous. They won't make headlines on CNBC or Reddit, but they work month after month, year after year, because true wealth isn't about how much you make, it's about how much keeps showing up even when you don't have to. And that's exactly what this strategy delivers. So the next time someone asks how you make your money, you can just smile and say, I get paid by the market. Like and subscribe for more.
When you see an ETF offering a 10% yield or higher, your first instinct might be excitement. Who wouldn't want to earn double-digit income every year without lifting a finger? But here's the thing. Behind those mouth-watering numbers, there's usually a catch, and that catch can mean the difference between building long-term wealth and slowly watching your portfolio drain away. So today we're breaking down the truth about high-yield dividend ETFs, the ones promising 10%, 12%, sometimes even 15% annual yields. We'll unpack how they work, where the money actually comes from, and why that income might not be as stable or even as real as it seems. By the end, you'll know exactly what separates a smart income strategy from a slow-motion disaster. Let's start with the basics. When you invest in an ETF, that yield number you see, say 11%, is calculated by dividing the fund's annualized distributions by its current share price. So if the fund paid $1.10 in dividends over the last year and the price is $10, that's an 11% yield. Sounds great, right? But here's the trick. If that ETF's share price keeps falling, the yield appears to rise even though you're not actually earning more. It's a mirage, a byproduct of declining asset value. This is where many investors get fooled. They see a high yield and assume it means high income. But sometimes what's really happening is that the ETF is just paying back your own capital, essentially giving you your money back while eroding its net asset value or NAV over time. Take the example of popular covered call ETFs like QYLD, RYLD, or XYLD. These funds generate income by selling call options on indexes like the NASDAQ 100, the Russell 2000, or the S&P 500. Each month, they collect premiums from those options and pass that money to investors as dividends. That's how they achieve such high yields, often between 10% and 12%. But here's the downside. When markets rise sharply, those call options cap the fund's upside potential. In simple terms, they trade long-term growth for short-term income. Let's unpack that. A covered call strategy works like this. The ETF owns a basket of stocks and sells call options on them. That means it agrees to sell those stocks at a predetermined price if they rise beyond a certain level. The buyer of the call option pays a premium upfront. That's where the income comes from. But in exchange, the ETF gives up most of its growth potential above that strike price. So if the NASDAQ surges 20%, QYLD only captures maybe 3% to 5% of that because it's locked into those options. Over the last decade, QYLD has paid consistent dividends, yes, but its share price has barely moved or even declined. Meanwhile, the NASDAQ 100 itself soared more than 250%. Your monthly dividends look strong, but your portfolio doesn't grow. And without growth, inflation eats away at your real income power. And that's where the warning lies. High yield isn't free. It's a trade-off between income now and growth later. If your ETF is constantly depleting its capital base to sustain payouts, you might end up with a shrinking portfolio even as those monthly deposits hit your account. Let's look at an example. Imagine you invest $100,000 into a 12% yield ETF that pays $1,000 per month. Sounds fantastic, $12,000 per year in passive income. But if that fund's NAV drops by 6% annually because of capital erosion or poor market performance, after 10 years, your $100,000 could be worth only around $54,000. You'd have received your income, sure, but you've also lost nearly half your principal. That's the trap of unsustainable yield. So what drives this erosion? For many of these funds, it's the way distributions are structured. In covered call ETFs, part of the income often comes from return of capital, or ROC, which is literally a payout of your own investment money. While ROC isn't automatically bad, it can be tax efficient, it becomes dangerous when it's used to mask poor performance. If you read the fine print of QYLD or RYLD's distributions, you'll often find a portion categorized as return of capital. It means the fund is paying investors by slowly selling itself. Other high-yield ETFs, particularly those investing in leveraged debt or emerging market bonds, amplify income using borrowed money. Leverage magnifies returns, but it also magnifies losses. When rates rise or markets drop, these ETFs can implode faster than investors expect. Here's something most investors don't realize. The way a fund distributes income matters almost as much as how much it distributes. When a covered call ETF sells options at, say, a 5% out of the money strike price, it's already predicting and limiting how much it expects the underlying index to grow that month. Over a full year, this subtle cap compounds into significant opportunity cost. If the market rallies 15% in a year, but your ETF caps out at 2%, you're giving up 13 percentage points of growth. Multiply that over a decade, and you're looking at a portfolio that's hundreds of thousands of dollars smaller than it could have been. This is especially critical during the early stages of a bull market. When the market's been sleeping, volatility is low, and option premiums shrink. That means the fund's yield drops just when you thought your income was locked in. JEPI and similar managed covered call funds experienced yield compression in 2023 to 2024 precisely because of this. Lower volatility meant smaller premiums, which meant lower payouts. Investors who relied on that 10% yield suddenly found themselves getting 6% or 7%. Now, does this mean all high-yield ETFs are bad? Not at all. But it does mean you need to understand what's under the hood, because not all income is created equal. Let's break down a few examples. QYLD pays monthly income from selling call options on the NASDAQ 100. It yields around 11%, but total return over 10 years is roughly half that of the NASDAQ itself. JEPI, the JP Morgan Equity Premium Income ETF, takes a more conservative approach. Like QYLD, it uses covered calls, but in a more active, risk-managed way. JEPI targets lower volatility stocks, think Microsoft, Johnson & Johnson, Procter & Gamble, and writes options selectively. The result? Around 8% yield with far better capital preservation. Its total return over the last few years has actually been competitive with the S&P 500, especially when you factor in dividends. And DIVO, the Amplify CWP Enhanced Dividend Income ETF, focuses on dividend stocks first and sells calls selectively, yielding around 5% to 6% while maintaining growth potential. The key difference? GPI and DIVO balance income with total return. QYLD prioritizes yield alone. That's the fundamental choice investors must make. Do you want the biggest possible paycheck today or the healthiest portfolio tomorrow? Let's say you're looking to live off dividends in retirement. A high-yield ETF might sound like the dream. Monthly payments covering your bills, predictable cash flow, no stock picking required. But unless that yield is sustainable, you're just liquidating your portfolio slowly. The best approach is balance. Combine moderate yield ETFs with reliable dividend growth funds so your income grows with inflation while your principal stays intact. For instance, a blended ETF portfolio might look like this: 40% VIG, Vanguard Dividend Appreciation ETF for dividend growth and stability, 30% GPI for consistent monthly income, 20% SCHD Schwab US Dividend Equity ETF for strong fundamentals and value exposure, 10% in bond ETFs like AGG or BND for ballast. That mix gives you a yield around 5% to 6%, not as flashy as 12%, but it's sustainable and backed by quality assets. Over 10 to 20 years, that's what builds true financial freedom. Here's a scenario that keeps retirement planners up at night. You retire with a portfolio of high-yield ETFs generating monthly income. Everything looks perfect until suddenly the market drops 30%. Your ETF's yield spikes because the share price plummeted. But here's the painful part. That income might be unsustainable going forward. The option premiums that funded those payouts depend on volatility staying elevated. Once volatility normalizes, so does your income. But you've already built your retirement budget around the higher payout. This is sequence of returns risk, and it's why relying solely on high-yield funds in early retirement is dangerous. The safer approach? Maintain a 2 to 3 year cash buffer alongside your income portfolio. This protects you from having to sell shares during downturns and lets you weather the inevitable periods when high-yield ETF distributions shrink. Now let's talk about reinvestment, because this is where the compounding magic happens. If you're still in the accumulation phase and don't need income yet, reinvesting those dividends, even from moderate yield ETFs, can massively accelerate your growth. For example, $100,000 invested in SCHD with a 3.5% yield reinvested over 20 years could grow to over $400,000 at an 8% annual return rate. Compare that to a high-yield ETF with 10% payouts but zero growth. You'd collect income, yes, but your base might stagnate. Let's simulate real-world outcomes. Imagine two investors, both investing $100,000 each into two portfolios, one in QYLD with a 10% yield but 0% price growth, and one in GP with an 8% yield and 4% annual growth. After 10 years, QYLD's total value would still be roughly $100,000. You've collected income but no appreciation. GP, on the other hand, would grow to about $148,000, even after accounting for payouts. That's a $48,000 difference, enough to fund an extra year or two of retirement expenses. Another factor often overlooked is tax efficiency. Many high-yield ETFs distribute income that's taxed as ordinary income, not qualified dividends, which can eat up your returns. A 6% qualified yield can actually beat an 8% unqualified one after taxes. Holding high-yield ETFs in tax-advantaged accounts like IRAs or 401ks can help, while keeping growth-focused ETFs in taxable accounts allows you to benefit from lower long-term capital gains rates. But the real challenge is behavioral. High yields feel comforting. They give the illusion of control, money arriving monthly, even in volatile markets. That consistency can make investors ignore the bigger picture. It's why some people hold on to eroding funds for years, telling themselves, at least it's paying me. In reality, that steady drip of income might be slowly draining their wealth. So what are the safer high-yield alternatives? Covered call ETFs can be fine as part of a diversified income strategy, especially funds like JEPI or DIVO that manage volatility carefully. For higher but stable income, look at preferred share ETFs like PFFD or PFXF, which yield around 6% to 7%, but are backed by financial institutions. For those comfortable with risk, BDC ETFs or REIT ETFs can provide 8% plus yields, but it's crucial to choose ones with solid track records and conservative management. And then there's the slow and steady route, dividend growth ETFs like VIG, SCHD, or DGRO. They may not have double-digit yields, but their dividends increase every year. And that's what truly fights inflation and sustains income through market cycles. Let's look at what that means in practice. Imagine two investors. Investor A chooses a 10% yield ETF that pays monthly, but loses 4% in NAV each year. Investor B chooses a 4% yield ETF that grows dividends by 6% annually and appreciates at 7%. After 20 years, investor A might have enjoyed higher cash flow early on, but their portfolio could be worth half of what it started with. Investor B, on the other hand, could see their portfolio double or triple in value, while their annual income also doubles through compounding dividend growth. That's why the smartest income investors think beyond yield. They focus on total return, the combination of income and appreciation. Because it's the total return that determines how long your wealth lasts, not just how big your next dividend check looks. Risk management should always come first. A rule of thumb, if a fund's yield looks too good to be true, check its 5 or 10-year chart. Has its price stayed stable? Have dividends grown or shrunk? If the distributions have been cut multiple times, that's a red flag. Finally, let's talk about investor mindset. The goal of high-yield investing shouldn't just be about maximizing income. It should be about aligning your portfolio with your goals. If you're nearing retirement and need reliable cash flow, a mix of moderate yield ETFs and dividend growers might suit you. If you're younger, prioritizing reinvestment and growth will give you far more freedom later. The takeaway is simple. Don't chase yield. Understand yield. Because true financial independence isn't built on unsustainable payouts. It's built on balance, consistency, and compounding. At the end of the day, high-yield ETFs can play a role in your strategy, but they're seasoning, not the main course. Think of them as the spice that adds flavor to a diversified portfolio, not the meal itself. The best portfolios blend income, growth, and stability in proportions that fit your risk tolerance and time horizon. So next time you see an ETF flashing a 12% yield, pause. Ask yourself, is this income sustainable, or am I just getting my money back in disguise? Once you start thinking that way, you'll see the investing world very differently and much more clearly. Because smart investors don't just chase returns, they build wealth that lasts.
Now let's step into something that's a little more under the radar. SVOL, the Simplify Volatility Premium ETF. This one's genius in its simplicity. Instead of stocks or bonds, SVOL sells short volatility through VIX futures. Basically, it profits from calm markets as volatility decays. By capturing that premium, SVOL distributes a steady 15 to 18% yield. What's impressive here is that it's built with a hedge. It actually buys out-of-the-money VIX calls to protect against spikes in volatility, meaning you don't get wiped out during a market panic. Funds like SVOL have quietly been outperforming traditional income funds because they generate cash from market behavior itself. The fourth ETF that's making serious waves is RSPY, a synthetic high-yield ETF built to mimic a risk parity strategy. It blends stocks, bonds, commodities, and derivatives to maintain balance while optimizing for yield. On paper, it doesn't look flashy, but it's been quietly distributing around 16 to 20% in yield, without decay seen in leveraged ETFs. How? Because it constantly rebalances, trimming risk when markets overheat and adding exposure when volatility cools. Think of it as the disciplined income investor's dream. You're getting a high payout while the fund manages drawdowns for you. RILD, the Global X Russell 2000 cover-to-call ETF, targets small-cap stocks, offering higher volatility and premiums. RILD delivers around 15 to 18% annualized yield with monthly distributions, reliable income despite market downturns. Pair RILD with JEPI or SVOL for a balanced portfolio balancing stability and aggressive growth. Allocate strategically. 25% JP, 25% QYLD, 25% SVOL, 25% RYLD for an average yield of 18 to 20%. On a $100,000 portfolio, expect $1,500 to $1,700 monthly income. Scale to $1 million for over $17,000. Unlike volatile assets, these ETFs provide real, steady cash flow. Even the best high-yield ETFs can suffer if you don't reinvest or manage your risk. Income investing isn't about chasing the highest number. Look at distribution sustainability. Is the yield based on real earnings or just return of capital? Track NAV stability. Most investors are wired for growth, not income. They want big stock stories, not quiet compounding of dividends. Wealthy investors understand the power of cash flow. Predictable, passive income gives you freedom. Many of these ETFs pay qualified dividends, taxed at lower rates, adding more money to your pocket. Pair with a tax-advantaged account, like an IRA, to maximize your compounding even more. Diversification is key. Don't go all in on one strategy. Mix high-yield ETFs with core holdings like bond ETFs or dividend aristocrats. Think of your high-yield ETFs as your cash flow engine. They generate the income for reinvestments, lifestyle, or long-term growth. Track your yield on cost. Over time, as you reinvest, your effective yield grows, even if the fund's yield percentage stays the same. The market has its skeptics. Some say high-yield ETFs are ticking time bombs. The truth is, smart investors manage and rotate effectively. With high-yield ETFs, your assets send you checks monthly. That's real financial independence. Income independent of your boss or market euphoria. Imagine waking up on the first of every month to find $1,400 deposited automatically in your brokerage account. No stress, just passive income. Dream of replacing your paycheck with passive income? This is the strategy that gets you there faster than you think. It's not about luck or gambling. It's about structure, research, and discipline. Focus on ETFs with sustainable yield models, low NAV decay, strong management, and monthly distributions. Examples include JEPI, QYLD, RYLD, SVOL. Combine these ETFs intelligently and protect your downside. You're not just building a portfolio, you're building freedom. At the end of the day, this game is about freedom. Your money should work harder than you do. The psychology behind income investing is often overlooked. It's not just about financial freedom and passive income, but a mental journey. Income investing requires discipline, patience, and a long-term mindset. It's not about chasing the latest trend. Building an ETF income portfolio is slow and steady. It doesn't give you that instant dopamine hit like day trading. Most investors fail not from bad investments, but from quitting too soon. They forget that dividends stack invisibly. Wealth grows in invisible layers, brick by brick, through monthly distributions and reinvested shares. The impatient investor misses this. The smart investor sees beyond a flat chart. Hope for success is different from building it. Emotional control is worth more than financial IQ in this game. Markets dip, and you might hear, "Sell now before it gets worse." Those dips are when your yield spikes. Stay calm and reinvest when others panic to lock in higher returns for life. The same $1,000 dividend that bought 50 shares last month might buy 70 this month if prices drop. That's leverage disguised as opportunity. One of the biggest mistakes is chasing yield blindly. A 25% dividend can be tempting, but not all yield is created equal. Some yield is pure return of capital, meaning the fund is paying you back your own money. That's not income. Always check the fund's distribution breakdown. If over 40 to 50% are ROC, ask why. It might not generate enough cash to sustain payouts. The second big mistake? Ignoring NAV decay. High-yield ETFs like QYLD or RYLD can seem like they're losing money, but that's not the whole story. These funds trade upside for income. When you consider distributions, your total return may surpass traditional equity ETFs. If your aim is income, price stability is crucial. Expecting growth like Tesla from a high-yield ETF leads to disappointment. The third mistake? Lack of diversification across yield types. Relying on one strategy can hinder returns in a rally. Mixing yield mechanisms is smarter. Using JEPI, SVOL, XYLD, or DEVO can stabilize returns in different market conditions. Think of it as an orchestra of income. Each plays a role, but together they create harmony. Let's say your portfolio pays $2,000 a month in dividends. You could withdraw that, but what if you reinvested just half of it? That $1,000 monthly reinvestment means you're buying more income every month. Over time, your future payouts increase exponentially. After 2 or 3 years, your reinvested income alone might cover your living expenses. That's when you cross into financial independence. Now let's talk about risk management. High-yield strategies aren't magic. They carry exposure to volatility and market shocks. The secret isn't avoiding risk, it's managing it smartly. One strategy I love is rotational rebalancing every few months. Trim a bit from the top performer, add to the laggard, and rebalance your weights. This forces you to sell high and buy low. Another strategy? Setting a dividend buffer. Save 10 to 15% of your income in cash or a money market fund. When markets correct, you can use that buffer to buy more shares at discounted prices, compounding your yield on cost. One of the smartest things you can do is hold your high-yield ETFs inside a tax-advantaged account like a Roth IRA or 401k. Focus on funds with tax-efficient structures that generate option premium income classified as capital gains, not ordinary income. Document your income journey. Every month, record how much our portfolio paid you. Watch it grow. Seeing those numbers move can change your mindset. Passive income isn't just a fantasy. It's real and measurable. This system works even better when markets are uncertain. Experienced investors welcome red markets. Cash flow continues. Imagine not just building income for yourself, but building a legacy. Every reinvested dividend becomes an asset that outlives you. Someday, someone you love could inherit a machine that keeps printing money. That's what real wealth looks like. Freedom that passes on. There will be months when your ETFs drop in price and you'll question everything. That's when discipline matters most. Understand the fundamentals. Your income is still flowing. Your yields are still compounding. Short-term fluctuations won't scare you. Start small, but start now. Don't wait for the right market. Be consistent. Every month you delay is a month you could have compounded. Even $100 invested today can start that snowball rolling. The key is consistency, not perfection. When you see those deposits hitting your account every month, you realize you're no longer working for money. Your money's working for you. That's one of the most liberating feelings in the world. Research these ETFs, understand their structure, look at their distribution history, and build a mix that suits your risk tolerance. Don't copy blindly. Customize intelligently. Start tracking your income, reinvest regularly, and protect your capital like a pro. Do this consistently for a year, and I promise you'll look back and wonder why you didn't start sooner. This isn't just about numbers. It's about freedom. The freedom to choose how you live, where you live, and what you do with your time. If you found this breakdown valuable, hit that like button, subscribe, and share this with someone still chasing hype instead of building freedom. Build your system, make your portfolio your paycheck, and let compounding take care of the rest. Most people spend their lives chasing paychecks, but never build systems that pay them. Imagine every first week of the month, Jeppy hits your account with dividends. A week later, RYLD follows, and a few days after that, you get a payout from Devo. It's like your portfolio has its own payroll calendar. Every month, you're getting paid by the market, not your boss. That's what true financial rhythm feels like. One viewer commented, "I started small, just $200 a month in JEPI. A year later, I'm getting $36 in dividends each month." It's not much, but it's a start. You don't need thousands to begin. You just need the mindset to start. Once you see those first deposits, something clicks. It's proof your money can grow and give back, quietly and consistently. When you wake up and realize your portfolio covered your rent, you'll understand what real financial freedom feels like. It's not about yachts or private jets. It's about peace. It's about knowing your future is funded. Stay patient, stay disciplined, and keep that compounding engine running. The markets will swing, but your income will keep rolling in. If this breakdown helped you see ETFs in a new light, hit that like button and share this video. Next week, I'm breaking down how to build a 3-fund portfolio that can outperform 90% of retail investors. You've probably seen those jaw-dropping dividend yields, 20%, 25%, even 30%. And you've thought, there's no way that's real, right? Every time you've looked into high-yield options, there's always a catch. The share price falls faster than dividends come in. But what if I told you there are ETFs paying between 15% and 33% annualized yields without eroding your portfolio? Today, we're diving into 5 ETFs that are quietly turning monthly income into a wealth engine for investors. High-yield investing is not a get-rich-quick strategy. It's a cash flow strategy anchored in understanding risks and sustainability. A 20% yield means nothing if your fund drops 30% every year. Balance is key for serious income. Let's start with JEPI, the JP Morgan Equity Premium Income ETF. A cult favorite, it pays around 10 to 12% annual yield, distributed monthly. Managed by a respected financial institution, JEPI uses a covered call strategy, owning large-cap U.S. stocks and selling options to generate income. Thanks to its blue-chip stock holdings, JEP offers less price volatility, providing more stability compared to pure option-based funds. Next is QYLD, the Global X Nasdaq 100 Covered Call ETF. This ETF is a bit more aggressive, focusing on major tech companies. QYLD writes covered calls on the Nasdaq 100, generating around 12 to 15% yield, but capping upside gains during market rallies. In flat or down markets, QYLD shines, providing income while others wait for price appreciation, turning stagnation into opportunity. Today, we're diving deep into the best dividend ETFs you need to know. Dividends are powerful, like getting paid to own stocks. If you've ever wondered how to build wealth passively, dividend ETFs are a game changer. We'll break down 5 of the best options. ETFs are baskets of stocks or assets that trade on the stock exchange, just like a single stock. Dividend ETFs focus on companies with consistent dividends. You get exposure to multiple companies, reducing risk while earning payouts that can compound over time. It's a proven strategy. Being patient and consistent with dividend investing can lead to steadily growing wealth. The first ETF is a favorite among dividend-focused investors, a fund targeting high-quality, dividend-paying U.S. companies. Think of it as the foundation of your portfolio. These funds typically include giants in technology, consumer staples, utilities, and healthcare. Examples include Johnson & Johnson, Procter & Gamble, and Microsoft. The advantage is stability. These aren't speculative stocks. They're established businesses with long histories of paying dividends. Next up, we have ETFs focusing on high-yield dividends for those looking to maximize income. These include companies with above-average dividend payouts. Sectors like real estate, energy, or telecommunications typically feature these companies. The appeal is clear: more dividends, more cash flow. However, higher yields often come with higher risk, so it's essential to balance these with more conservative dividend funds. Many savvy investors mix high-yield ETFs with core dividend funds to capture income without excessive risk, especially if reinvesting dividends. International dividend ETFs invest in companies across Europe, Asia, and other emerging markets. They provide global exposure and diversification. These ETFs give you access to global giants and industries not available in a US-only portfolio. It's a great way to diversify. Keep in mind, currency fluctuations and geopolitical risks can affect returns, but they help balance your risk and offer growth opportunities. Another category to consider is dividend growth ETFs. They target companies that consistently raise dividends over time. Dividends are important. Companies like Apple, PepsiCo, and Visa often appear in these ETFs, reflecting strong financial performance. Dividend growth offers a dual advantage of income and portfolio appreciation, significantly outperforming simple, high-yield strategies over time. These funds focus on industries known for steady dividend payouts, such as utilities, consumer staples, or healthcare. By targeting these sectors, investors can fine-tune their income strategy based on their risk tolerance and market outlook. Utilities, for instance, provide consistent dividends even in downturns because people need electricity and water. It's vital to avoid over-concentration. Sector-specific ETFs work best as complements to broader dividend ETFs. If you invest $10,000 in a core dividend ETF yielding 3% annually, that's $300 in dividends each year. Now imagine adding a high-yield ETF with a 5% payout. Your income jumps to $500 annually from that part alone. Over a decade or two, these strategies can transform a modest investment into a substantial income-generating machine. Don't put all your eggs in one basket. A balanced dividend ETF portfolio might include a core U.S. dividend fund, a high-yield fund, and more. By combining these, you spread risk across companies, sectors, and regions. If one area underperforms, the others can compensate. Remember, dividend investing is about consistency over time, not chasing short-term gains. Patience and discipline are your best allies. Pay attention to fees. ETF expense ratios vary, and even a small difference can add up over time. Look for ETFs under 0.5%. Tax efficiency is also a factor. Be aware of tax implications helps you plan smarter. Small differences can compound over the years. Dividend reinvestment plans, or DRIPs, allow you to automatically reinvest dividends into more shares of the ETF, creating a snowball effect. This accelerates wealth growth as your dividends earn more dividends. Many brokers offer DRIPs with no additional fees. The key here is consistency. The earlier and more consistently you reinvest, the greater the compounding impact. Investors worry about dividend cuts due to economic downturns or company struggles, making diversified ETFs essential. While a single company might cut dividends, diversified ETFs cushion the impact across many holdings, helping you stay calm. Dividend ETFs aren't just for retirees. They can supplement portfolios, provide cash flow, and reduce volatility. Younger investors can use dividend ETFs as growth components while building passive income streams early. Dividend investing is less about timing the market and more about staying invested over the long term. Regular contributions, whether markets are up or down, create a compounding effect that smooths out market cycles. Consistency beats trying to predict market tops and bottoms. Economic cycles affect dividend-paying companies. Utilities and consumer staples tend to be more resilient in downturns. By holding diversified dividend ETFs, investors balance exposure across sectors that react differently. Dividend investors often develop patience and discipline. Receiving regular payouts reinforces the value of long-term investing. Watching dividends grow over time provides both psychological and financial rewards. Technology and online tools make dividend investing easier than ever. You can track ETF performance, set up automatic contributions, and monitor dividend schedules. Many investors use alerts to stay informed about dividend changes, payouts, and market news. Technology streamlines portfolio management. Imagine combining a broad U.S. dividend ETF, a high-yield ETF, an international dividend ETF, and a dividend growth ETF. Your portfolio spreads across hundreds of companies. Each quarter, you receive dividends that are reinvested automatically, compounding steadily over time for income and portfolio growth. Investors should remember that past performance is not a guarantee of future results. Market conditions change, but core principles remain sound. Combining strategies with ongoing learning and portfolio review positions investors to maximize returns over time. It's important to periodically rebalance your dividend ETF portfolio to maintain your intended allocation and risk profile. If high-yield ETFs outperform and take up a larger portion, trimming shares and reallocating to core or international ETFs helps maintain balance. Many investors combine dividend ETFs with other income strategies, like bonds or real estate, to diversify. Bonds provide fixed income, while dividend ETFs add equity exposure, reducing overall portfolio volatility. Sustainable and ESG dividend ETFs focus on companies with strong governance practices while providing income, aligning ethics with finances. Behavioral discipline remains critical. The temptation to chase higher yields can erode long-term results. Dividend ETFs can serve as a hedge against inflation. They offer pricing power and the ability to grow earnings. This growth leads to higher dividends, helping maintain real purchasing power in your portfolio. Watching dividends accumulate reinforces disciplined investing habits. Regular payouts keep investors engaged. Dividend ETFs can be passed on to heirs, providing ongoing income while maintaining equity exposure. One of the often overlooked benefits of dividend ETFs is their versatility across different market conditions. Unlike growth-focused ETFs, dividend ETFs provide a steady stream of income regardless of market volatility. This consistency is valuable during recessions. Investors who rely solely on capital appreciation often feel pressured to sell. With dividend ETFs, the dividends continue to flow, offering a source of reassurance and stability. Another key factor is sector diversification within dividend ETFs, reducing exposure to sector-specific risks. Tax efficiency is another crucial advantage. Qualified dividends are taxed at a lower rate than ordinary income, making dividend ETFs more attractive. Some dividend ETFs are structured to minimize capital gains distributions, further enhancing tax efficiency. This can mean keeping more money working for you. The compounding effect of reinvested dividends coupled with tax efficiency can significantly amplify overall returns over decades. Automatic dividend reinvestment plans, DRIPs, allow investors to purchase additional shares with earned dividends, compounding wealth over time. Small, consistent reinvestments can grow into substantial holdings. An investor could potentially double or triple their portfolio in 15 to 20 years. The long-term effect of compounding, especially with growing dividends, is a powerful wealth-building mechanism for everyday investors. Dividend ETFs can act as a buffer against inflation. Companies that consistently increase dividends often have strong pricing power, passing cost increases to consumers. This pricing power allows dividends to grow over time, maintaining real purchasing power. For example, if a dividend ETF yields 4% today and dividends grow by 5%, the real yield protects income. This makes dividend ETFs especially attractive in inflationary environments, where traditional fixed income products like bonds may fail to keep pace with rising costs. Another significant factor is global reach. Some ETFs focus on U.S. companies, while others provide exposure to international dividend payers. This global exposure allows investors to capture opportunities in emerging markets, Europe, and Asia, offering higher yields due to differing corporate practices. The presence of dividends provides a tangible reward even when stock prices are temporarily falling. Receiving regular dividend payments helps investors psychologically separate income from market price fluctuations. This emotional benefit is particularly valuable for younger investors who may face market volatility over multiple cycles. Dividend ETFs encourage patience and discipline, traits that are statistically correlated with superior long-term investment performance. For income-focused investors, dividend ETFs offer a reliable alternative to bonds, especially in a low-interest rate environment. Dividend ETFs provide exposure to equity income, often outperforming bond yields over long periods, while offering potential for capital appreciation. The combination of income and growth makes dividend ETFs a hybrid solution, blending the stability of fixed income with the upside of equities. Long-term investors should consider the compounding effect of dividend growth. Companies that consistently raise dividends exhibit strong fundamentals. Dividend growth ETFs aggregate these companies, creating a self-reinforcing ecosystem. As dividends grow, reinvested dividends buy more shares, generating even more dividends. Modest dividend growth rates of 5 to 6% per year can substantially increase portfolio value and generate a reliable income stream in retirement. Dividend ETFs reduce the temptation to chase speculative growth stocks and typically include mature, cash-rich companies. In periods of market uncertainty, these ETFs often experience less volatility, offering both income and relative stability. Pension funds and endowments allocate to dividend-focused strategies, combining yield with relative safety. This recognition adds credibility to dividend ETFs, making them a core component of a well-structured, long-term portfolio. Dividend ETFs benefit from economies of scale and efficient management, reducing costs for investors through lower expense ratios. Unlike mutual funds, ETFs offer liquidity and transparency, allowing investors to buy and sell shares throughout the trading day. This combination makes dividend ETFs accessible for investors at all levels, from beginners to seasoned professionals. Dividend income provides predictable cash flow for retirees who want to avoid tapping into their principal. Reinvesting dividends can compound wealth, creating a larger retirement nest egg over decades. Look for ETFs that emphasize quality, companies with low payout ratios, consistent earnings, and strong balance sheets. These factors increase the likelihood that dividends will continue growing even during economic downturns. Technological advancements and automation have enhanced dividend ETF performance, optimizing selection and monitoring. Robo-advisors, algorithmic trading, and AI-driven analysis allow investors to efficiently reinvest dividends. These tools democratize access to portfolio management, giving retail investors a competitive edge. Dividend ETFs now align with socially responsible and ESG-focused strategies, meeting investor values. Dividend ETFs provide stability, growth, and compounding power for long-term wealth and reliable income. If you found this breakdown helpful, hit the like button, subscribe for more insights, and share your thoughts.